All right, UPSC aspirants, and welcome. In this explainer, we're going to do a super fast run through of the core concepts from the Class 12 Ncert Macroeconomics textbook. Let's get right into it. Okay, so here's what we're going to cover. We'll be hitting 5 really crucial chapters, starting with what macroeconomics even is, then how we measure national income, onto money and banking, the government budget, and we'll finish up with the open economy.
First up, let's get our heads around the big picture of macroeconomics. Why is this subject so incredibly important?
Well, you can't really talk about modern macroeconomics without talking about this guy, John Maynard Keynes. It was his game-changing book from 1936, The General Theory of Employment, Interest, and Money, that pretty much laid the foundation for this whole field as we know it today.
So, what is it really? In a nutshell, macroeconomics looks at the entire economy as one big system. It's all about how these massive factors, like employment, national output, and inflation, all connect and influence each other. Think of it this way. It's about studying the entire forest, not just the individual trees.
Okay, time to test your knowledge. First revision question for you. What was the major global event that really gave birth to modern macroeconomics?
And the answer, of course, is the Great Depression of 1929. This was such a catastrophic event that it completely shattered the old classical idea that economies would just fix themselves. And just to give you a sense of the sheer scale of this thing, between 1929 and 1933, the unemployment rate in the US just exploded from 3% to 25%. I mean, a shock of that magnitude, it just demanded a completely new way of thinking about the economy. Okay, so we know what macroeconomics looks at, but how do we actually measure the performance of a whole economy? Well, that brings us to national income accounting. Now, to get an accurate picture of national income, you absolutely have to understand the difference between final and intermediate goods. Final goods, like a car someone buys to drive, are at the end of the line. Intermediate goods, like the tires sold to the car company, are just inputs. Getting this right is so crucial to avoid double counting and making the economy look bigger than it actually is. And this is a really key point to remember. A higher GDP doesn't automatically mean people are better off. GDP as a number has its limits, right? It totally ignores all the unpaid work done at home, it doesn't subtract the costs of things like pollution, and it tells you nothing about who's getting all that income. All right, another classic concept check for you. Question number 2. Is a company's inventory, all those unsold goods sitting in a warehouse, a stock or a flow variable? Yep, the correct answer is stock. You measure inventory at a single point in time, like on December 31st. On the other hand, things like production or sales, which you measure over a period of time, like a month or a year, those are flow variables. Okay, let's move on to the absolute lifeblood of any modern economy, money. We're going to quickly revise the role of money, the banking system, and of course, India's central bank, the RBI. We kind of take money for granted, but it's brilliant because it solves all these huge problems that you get with a barter system. With barter, you need a double coincidence of wants. I need to have what you want, and you need to have what I want. Money just becomes a medium of exchange. Barter doesn't have a common unit of account, but money gives us that standard value. And it's tough to store value with barter, but money lets us save for the future. So, when you hear about the RBI's monetary policy, these 4 rates, repo, reverse repo, CRR, and SLR, are its main toolkit. By tweaking these, the RBI can control how much money is flowing through the economy, which helps them manage inflation and try to boost growth. Just take a second to refresh your memory on what each one does. Time for question number 3. Let's put this into practice. If the RBI wants to fight inflation, would it increase or would it decrease the cash reserve ratio, the CRR? The correct answer is the RBI would increase the CRR. And why is that? Well, think about it. A higher CRR means banks have to park more of their money with the RBI, leaving them with less to lend out. This sucks extra cash out of the system and helps cool down inflation. So the RBI has monetary policy, right? Well, the government has its own powerful tool, and that's fiscal policy. Let's take a look at how the government's budget shapes the economy. You have got to know the difference between these two. It's absolutely critical. Revenue expenditure. Think salaries, pensions. It's for running things, but it doesn't build any new assets. Capital expenditure, on the other hand, is all about creating new assets like roads and bridges. Understanding this difference is key to seeing the long-term impact of government spending.
And of course, we have to talk about GST. The NCRT book highlights it as this landmark reform. The whole idea was to replace that messy web of different central and state taxes with one single tax. The goal? To create a unified national market, summed up by that famous phrase, one nation, one tax, one market.
All right, for our final section, let's zoom out. We're going to look at how India's economy plugs into the rest of the world. And to do that, we need to revise the idea of an open economy and the balance of payments. So the balance of payments, or BOP, is really split into two key accounts. You have the current account, which tracks the flow of income, things like exports, imports, and remittances. Then you have the capital account, which is all about transactions in assets, like foreign direct investment coming in or loans going out.
Okay, here we go, our final revision question. Let's see what you've got. If a country is importing more goods than it's exporting, where exactly does that deficit show up? Which specific account? The answer to that last one? It's the trade account, which, as you know, is a part of the current account. And that, everyone, wraps up our super fast revision, but I want to leave you with one final thought to chew on. In today's deeply interconnected world, how much real control does a single nation's fiscal policy actually have over its own economic